I've spent the last 11 years in the world of finance, both making good and bad personal finance decisions, all while learning a lot along the way. I'm going to share real-world financial questions and situations to help you get out of debt, stay out of debt, and build wealth. Let's get started. Confession number 1, home buying help. Buying versus renting home. My current lease ends November 10th. I will be moving out of my place when it is over. Up until a few days ago, I was considering renting a house because my current 1-bed, 1-bath apartment is $1,500 a month, and a 3-bed, 2-bath house in my area is leasing for around $1,800 to $2,000 a month. But now the idea of buying a house crossed my mind. Here's my lengthy question. If I know I'm going to be living in my next place for 24 months and assume with an upgraded minimum 2-bed, 2-bath apartment house lease rate of $2,000 a month, would it not make sense to buy a house even with the high potential of losing money, being I would only be in it for 2 years? Because I would lose less than $48,000. Some more key information. I'm a first-time home buyer. My target house price is $250,000 to $280,000. My credit is about $750. My annual income is $85,000. My girlfriend will be moving in with me and we'll split the rent or mortgage payments. This is a great question. A lot of people have the idea that buying a house will be cheaper than renting. And in some instances, it can be. But in a lot of instances, like this example, it's going to cost you more than renting for a few years. And it's okay to rent. If you're gonna be living in a city for only 2 years, it's never a good idea because you can't guarantee what the housing market is gonna do in the next 2 years. You can't guarantee if it's gonna increase or decrease. And there's a lot of costs that are associated with buying a house that people don't look at or understand. There's closing costs on buying the house. That's gonna cost you 3-4% of the total price of the house. There's a lot of things that you have to account for when you're buying a house. And then when you're selling a house, on the flip side, there's typically 6% closing fees for the buyer and seller's commission, on top of additional stuff when it comes to moving out, when it comes to staging, when it comes to... So if you're buying a house for only 2 years, that's never a good idea because those costs are not going to offset it. And then when you're talking about $250,000 house, at current interest rates around 7%, you're going to be about $2,000 out the door in terms of your total payment when it comes to private mortgage insurance, property taxes, home insurance, principal, and interest. So your minimum payment on the house is going to be $2,000 versus your maximum amount on the house is going to be renting the house is $2,000. And that doesn't account for maintenance. It doesn't account for closing costs on the buy side or the sell side. So no, in this instance, if you're going to be living there for only 2 years, it does not make sense to buy a house. You want to buy a house if you're going to be living there for at least 5 years, if not longer, because a lot of these costs are expensive when it comes to transactions of buying and selling houses. Question number 2, should I pay off my car? I financed a car for $21,000 at 5.4% APR in 2020. I have $14,000 left on the car and I could pay it off now. I have $200,000 liquid, but I'm unsure if I should. The $200,000 are in a high-yield savings account at 4.55%. I'm confused if I should pay it off or just keep making monthly payments. Yes, you should pay this car off yesterday. You have the money sitting in your high-yield savings account, and that is only earning 4.5% interest, and that doesn't account for taxes. So if you account for 30% taxes on that, you're really earning less than 3.5%. You have the interest rate on a vehicle at 5.4% interest. So you should pay this off tomorrow, be done with the minimum payments, stay out of debt, and never finance a car again. And the rest of that money, you should keep some aside for emergency fund and a high-yield savings account, and the rest of it you should be looking at investing into the stock market, or are you saving that for a house, but you need to have a plan with that. Do not keep $200,000 in a high-yield savings account for the foreseeable future. Confession number 3, home buying help. Buying a house in our situation. My wife and I are almost a year into our careers. We have been renting so far and would like to start a family soon. However, we'd like to start one in a house instead of a duplex we're renting. I was looking for advice on what we should do. Our situation, my salary is $135,000. Her salary is $38,000. We have $120,000 in total student loans. Our car debt is $13,000. Our rent is $1,645. Total savings is $14,300. Retirement, I put 5% because they match for me in my 401k. I put another 5% into Roth IRA, but I stopped contributing to focus on debt and savings. So in my eyes, home buying should not be on the table until all this debt is paid off. You currently have over $130,000 of debt between the student loans and the car payment. That is going to prohibit you from living life, enjoying life, and being stress-free about money. When it comes to buying a house, you need to have money for a down payment. You need to have money for a closing cost. You need to have money for when stuff breaks, because stuff is going to break. And right now, $14,000 when you have $120,000 worth of student loan debt and over $10,000 in a car payment is not enough of an emergency fund for having a house and for having all that debt. So you have a great income between the two of you, over $170,000 a year. You need to be throwing as much money as possible towards paying these debts off as quickly as possible. It might be a 2-year process, but that's okay. And then once you get out of debt, then you can start saving more money quickly to save up to be able to afford a house. But right now, please do not go buy a house. A house will hurt you more ways than it will help you if you have this much debt and you don't have savings for a rainy day. Confession number 4, student loan help. I'm weighing student loan repayment versus savings versus investments versus mortgage down payments. My federal student loans have started accruing interest again, which means it's time to make a plan to pay them off. I'm trying to plan out the optimal way for me to pay them given my situation. I have $27,000 in federal student loans. These loans range from 3.76% to 5%. I have no other debt. My assets are $46,000 in a high-yield savings account at 4.25% interest, $26,000 in brokerage accounts. My take-home is $6,000 a month after paying benefits, Roth 401k contributions, up to the match and then some. My yearly bonus and stock grants amounts to about $16,000. I'm in a fortunate situation where I have no rent and very little expenses for the next 6 to 8 months, after which I'm planning to buy a house with my partner. Within the next year, my partner and I plan to buy a house with a budget range of $400,000 to $600,000 depending on the state taxes, location TBD. Partner's situation is comparable to mine. I'd like to keep an emergency fund, but we're fortunate to have sufficient safety nets that is not absolutely vital right now. It will be once we have a mortgage payments, of course. I'm in my mid-20s with a relatively high risk tolerance. Because we'll be looking to make a down payment within the year, I'd like to keep most of my money in the high-yield savings or in other relatively liquid investments. I understand that I'm extremely fortunate in a good spot, but I still want to make sure I'm thinking about this correctly and making prudent decisions. My current plan is to pay off $17,000 in loans starting with the highest interest. I then pay the rest off over time, but not sure how quickly. I'd like feedback on this, open to other repayment options. I'm planning on putting the rest of my extra income into the high-yield savings account to keep it readily available, but I'm open to other options as well. So you have $46,000 in your high-yield savings account, and that is earning 4.2% interest. That is before you're accounting for taxes. So really around 3% after you account for federal and state income taxes. And you have these student loans that are ranging between 3.7 to 5% interest rates. I would be debt-free tomorrow. I would take $27,000 out of that high-yield savings account, pay off all of the student loans tomorrow. You still have $19,000 left in your high-yield savings account, and that is an adequate emergency fund, and that is money that you can be saving towards this house down payment. Pay off the debt tomorrow, be debt-free, and stay debt-free. Confession number 5, opinions on paying down my mortgage versus maxing out my retirement contributions. I'm considering purchasing a house and want to get opinions about something. The house is a $239,000 asking price at 20% down over 30 years with about 7% on the mortgage. I'd be looking about $1,563 a month in payments between mortgage, property taxes, and insurance. I'm currently contributing an extra $29,000 a year into retirement between my employer's 403b and my Roth IRA. At 7% interest, you think I should be using that $29,000, pay down the mortgage until there's such a time, if any, I'm able to refinance or lower rate, or do you think I should continue to contribute to retirement? I know the average return for the stock market is 10%, but a guaranteed 7% return paying down the mortgage isn't bad either. Just wondering what you would do. A 7% interest rate is currently what the market is right now, which puts you in a tough situation determining whether you want to pay down your mortgage quicker or you want to contribute more to retirement. At 7% guaranteed rate on your return on money, if you're paying down the mortgage, I'll go that route with that high of an interest rate because the 10% is not risk-free. We're going to have some years that are down years, some years that are up years, and who knows what the next 40 years or next 20 years return of the stock market is going to be. It could be 5% annualized. It could be 15%. We don't know. I'll take your company match into your retirement accounts and then everything on top of that go towards paying down this mortgage as quickly as possible. Confession number 6, car buying help. Leasing to own or financing it right away. The way that sales lady explained it was if I leased, I am buying the first half of the car with a very low interest rate over 3 years, less than 1%. I understand that it would still be the dealer's car and there'd be a mileage limit that I'm not worried about. After the lease, I can take a loan out and pay for the rest of the car and have the title. Potentially the rates would be lower in 3 years. I understand that I would lose out on 3 years of paying the full loan if I would finance it from the beginning. Couldn't I put down a hefty down payment when I transition from lease to loan and make more principal payments during the life of the loan? Well, I never think it's a good idea to finance a car because you're signing yourself up for guaranteed payments for the next 5, 6, however many years you finance the car for. And you don't know what your financial situation is going to be 2, 3, 4, 5 years from now. Best cars are cars that are paid for in cash, and financing cars or leasing cars is a way that car companies make a lot of money off of you. Sales lady is pushing for the lease because, frankly, car companies make more money that way. What you need to look at is what can you afford in terms of a car right now that you're paying cash for and not financing it. So please don't lease the car. Please don't finance the car. Let's look at other options. Let's look at cars that you can save up for and pay for cash. Confession number 7, ex-girlfriend home help. I jointly own a home with an ex-girlfriend. She moved out 4 years ago. My girlfriend and I purchased a home together in Tennessee. Shortly thereafter, she cheated and we broke up. She moved back in with her parents and I haven't heard from her since. The loan and property are in both of our names. I know this was foolish to do. I've lived here alone since, and now her mom is coming to me saying that she wants her off the loan because it's affecting her credit. How do I get her off the loan without refinancing? My credit is poor enough that it really isn't an option, and I refuse to sell the house. I've been here paying for it and remodeling the place myself. They've mentioned she could sign a quitclaim deed. What advice would you give me? Your options are slim here to get her off of the loan. Signing a quitclaim deed will not get her off the loan. The only way to get her off the loan is if you refinance. Probably your best bet in this situation is find a real estate attorney to figure out what your options are. There are ways she could probably force you to sell the house because if y'all bought it together, she legally owns half of the equity of the house. So you need to figure out what are your options with a lawyer. Could you refinance it to get her off the loan and all that equity rolls into yours? Or are you going to have to refinance this to pay her out as well? So you need to really go talk to a lawyer, figure out what your options are. But since you do own this house, your options are limited in some of the things that you can or can't do. This is also an example of don't buy a house when you're dating someone because it can get ugly really quick. Confession number 8, which loan should I prioritize? I'm about to pay off my car, which is a $500 a month payment, and I'd like to put that $500 a month towards my other loans, which is my house and my pool. My house loan is $485,000 for 30 years at 4.875% interest. My pool is $100,000 for 20 years at 5.75% interest. How should I allocate the $500 to maximize my savings? Should I put it all towards my pool loan, paying it off first, and then put it towards my house? Or put it towards the house and just pay the pool over 20 years, or a mixture of both? Well, in either situation, whether you're going the debt snowball route or you're going the avalanche route, the pool would come first. The pool is the lower of the two balances, and the pool is also the higher of the interest rates. So put those entire $500 towards paying the pool off, and then once you get the pool paid off, start attacking the house. And also, please do not go finance a $100,000 pool. That is never a good idea under any situation. If you want to redo your bathroom, if you want to put a pool in, if you want to do any renovations to your house, you need to be saving up cash for it, and you need to be paying for it in cash. Do not finance renovations. Confession number 9, I'm turning 27 and I have no retirement. How screwed am I? I'm not the best with finances. I'm turning 27 soon and I have nothing in retirement. Fortunately, I do have $65,000 in savings. It is not even in a high yield savings account. Why? I don't know. I probably should. My income is $65,000 and I have no car payment. I plan to start by throwing $6,000 in a Roth IRA, and then I will enroll my company's 401k and do 20%. No match, 4% of that. If I do 20%, I should still be able to live comfortably. I work in IT. I'm expecting to make 6 figures in 5 years or so. I'm aware things could be worse, but being 27 with no investments kind of scares me. Taking action and making a change in your current financial situation. You are not in a bad spot. You have $65,000. You have no debt. Yes, it'd be good to have investments at this point, but you're debt-free and you have a $65,000 net worth. With that money that's in savings, I would allocate 3 to 6 months of living expenses into a high yield savings account and keep that there. And the rest of it, let's start figuring out an investment plan for it. Whether it's going towards maxing out your Roth IRA or putting in a taxable brokerage account. In regards to your 401k and retirement savings, the future, no, you're not far behind. Frankly, you're ahead of most people your age, having $65,000 set aside. But if you start investing the 20% into your 401k, that's about $12,000 a year, and you put $6,000 into your Roth IRA a year, that's about $1,500 a month. If you do that for the next 40 years until you're 67, you'll have $3.9 million by the time you retire between those two accounts. That is a phenomenal spot to be in. That is assuming that your income does not go up, that you can't contribute more money every single year to your retirement accounts or taxable brokerage accounts. That is putting in $1,500 a month, which you're going to start doing, into your retirement accounts. That also doesn't include your employer match. So no, you are not, it is not too late. Best time to start investing was yesterday. The next best time is today. So start your contributions, start contributing, start investing, and build out a plan for your money in your high yield savings account. Thanks for watching today. If you enjoyed this, learning about real financial situations, please hit the like and subscribe button. My goal is to help America learn about money, talk about money more, and get out of debt. We'll see you next time.